Are you trying to decide between two of the most popular balanced funds out there? Fidelity Balanced Fund, FBALX, and Vanguard Balanced Index Fund, VBIAX. These funds have been go-to options for investors seeking a blend of growth and income. But which one is truly the better choice? Let's dig into the numbers and performances, fees, and strategies that make them different. Fidelity's Balanced Fund is an actively managed fund, which means that professional fund managers are making decisions about where to allocate the fund's assets, aiming to outperform the market. The Vanguard Balanced Index Fund, on the other hand, is a passive index fund tracking the CRSP US Total Market Index. These two funds have similar allocations, about 60% in stocks and 40% in bonds, but the way they are managed is what sets them apart. One of the most important factors in deciding between these funds is the expense ratio. VBIAX from Vanguard has an ultra-low expense ratio of just 0.07%, which is one of the lowest you'll find in the market. In contrast, FBALX from Fidelity has a higher expense ratio of 0.51%, which may not seem like much, but over the longer term, this difference can significantly impact your returns. Now let's talk about performance. Over the last decade, VBIAX has outperformed many actively managed funds due to its low costs and straightforward strategy. In 2023, VBIAX delivered a return of 14.87%, driven largely by its exposure to large cap US stocks. FBALX, however, provided a higher return of 21.13% during the same period, thanks to its active management approach, which capitalized on market opportunities. This shows that while Vanguard offers more consistent returns, Fidelity's active strategy can sometimes outperform, especially in certain market conditions. Both funds maintain a 60-40 stock-bond split, which is great for investors looking for both growth and stability. Stocks provide a growth potential, while bonds offer income and stability during market downturns. This allocation is designed for moderate risk investors who want a balance between returns and risk. If you are thinking about long-term growth with lower volatility, both of these funds can be solid choices. In terms of size, FBALX has a net asset value of $45.89 billion, while VBIAX stands at $23.62 billion. Both funds have a large asset base, indicating that they are highly popular among investors. But size isn't everything. What really matters is how these funds perform relative to their costs and strategies. Vanguard's passive management strategy means it aims to track its index as closely as possible without trying to beat the market. This approach had led to stable and consistent returns for investors. Over the past 10 years, VBIAX has provided an average annual return of 9.22%, which aligns well with the performance of the overall market. Fidelity, however, takes a different approach. FBALX's active management allows fund managers to make adjustments based on market conditions, giving them the flexibility to invest in sectors or stocks they believe will outperform. These flexibility contributed to FBALX's impressive 2023 return of 21.13%, outpacing many other balanced funds, including VBIAX. But there are trade-offs. While active management can sometimes lead to better performances, it also comes with higher costs. Hence, FBALX's 0.51% expense ratio. That difference in cost may seem small, but over a 20 or 30-year period, lower fees like those in VBIAX can compound and make a significant impact on your overall returns. Both funds also pay dividends regularly. VBIAX has a 12-month trailing yield of 2.05%, meaning investors earn income from both stock dividends and bond interests. FBALX, on the other hand, has a slightly lower yield of 1.56%, but the higher returns from its active management approach can make up for the difference, especially in years when the market is performing well. One factor to consider when choosing between these funds is how they handle turnover. VBIX has a very low turnover rate of 6%, meaning that only a small portion of the portfolio is changed each year. This leads to fewer transaction costs and lower capital gains taxes for investors. FBALX, however, has a turnover rate of 29%, which is much higher. This means there are more trading happening within the fund, leading to potentially higher tax liabilities for investors. If you are an investor looking for low-cost investing with minimal management involvement, Vanguard's VBIAX might be the best option. The 0.07% expense ratio keeps costs incredibly low, allowing you to keep more of your returns over time. On the other hand, if you believe in the potential of active management and are willing to pay higher fees for the possibility of better performance, Fidelity's FBALX could be a better fit for you. Both funds are suitable for long-term buy and hold investors who are looking for a balanced approach to growth and income. However, if tax efficiency is a concern, Vanguard's lower turnover may offer an advantage. It's also worth noting that while VBIAX is passively managed, it has performed exceptionally well in both bull and bear markets due to its diversified exposure to large-cap US stocks and bonds. However, FBALX may appeal to investors who want their fund managers to have more discretion in picking investments that could outperform the markets. Finally, Fidelity's FBALX and Vanguard's VBIAX are excellent balanced funds with a 60-40 asset allocation. VBIAX shines with low expense ratio and passive strategy, making it ideal for investors looking for simplicity and long-term growth with minimal costs. Meanwhile, FBALX offers the potential for higher returns through active management, but at a higher cost. The choice between the two really depends on whether you prefer the hands-off, low-cost approach of Vanguard or the potential upside from active management offered by Fidelity. That's all for today. Subscribe to know more. Till then, goodbye.